Today's Talk About It Tuesday question is, my parents never invested in anything, but they consistently put money into a savings account. They amassed a lot of money over the years that they left to my siblings and I when they passed. Do I have to invest, or is consistently putting money in a savings account good enough? Well, I think in order to answer that question best, we have to compare some things. One, we have to compare the generation that your parents were investing or saving in to today. But we also have to compare the performance of investing versus savings today. So let's just start with the parents. And I don't know how old this person is. I don't know when their parents were saving, but I just chose a random time, 1980. So in 1980, the interest on a savings account was as high as 12.2%. That is phenomenal. That means for every $100 you put in there, you got $12.20 in interest. That is super phenomenal. But we can't look at 1 year. That was just 1980. If we look at the whole decade of the 80s, the whole 1980s, I did a little research, and in the 1980s, the average on that decade was between 5 and 8%. That is still phenomenal, and I tell you why. We have to compare the return on a savings account against the inflation rate. And why does that matter? Because if the inflation rate exceeds the interest rate, that means you didn't make any money in actuality. Confusing. In a good economy, we try to keep the inflation rate between 2 and 4%. That's a good economy, the inflation rate. That means what percentage the cost of goods and services increases over a year. And they always increase, right? 2% is phenomenal. 4% is decent. Above 4%, we consider that to be high inflation. The inflation rate was high at that time as well, but the interest rate was great. So you could put money in a savings account and get a decent return. And then we also have to look at that time. In the 1980s, there was an accessibility issue in regards to investing. We didn't have apps, and we didn't have online investing. You didn't have online brokerage accounts. That didn't exist yet. And so there was a barrier to entry for investing. You had to actually go to a physical brokerage house, and you had to hire a stockbroker who normally, if you didn't have a certain amount of money to invest, would not take you on as a client because they got paid off of transactions, right? When you bought and sold, they got a percentage of that. So there was an accessibility issue. There was a knowledge gap, right? Most people didn't even understand how investing worked. So the only avenue for preserving wealth or to gain wealth was a savings account. That was the best way. That, and of course, real estate if you owned a house, but people didn't really look at that too much as an investment. So when we look at that time period, that made sense for your parents to do a savings account. Now let's fast forward to today. The national average for a savings account is 0.38%. I didn't say it wrong. Less than 1%. 0.38% is the national average on a savings account. Compared to 1980 when it was over 12%, today is less than 1% on a savings account in a brick and mortar bank. Now, that still doesn't matter unless we compare it to the inflation rate. So, and again, let's do a single year, doesn't even matter. If we look at the last 20 years, just to be fair, if we look at the last 20 years, what the national average was in terms of on interest on a savings account, the national average is less than what it is today. 0.29% is the 20-year average for a savings account. Now compare that to the inflation rate. The inflation rate over that same period of time was 2.3%. So if you had money in the bank on the average of 0.29% and the inflation rate was 2.3%, you lost significant value of your money just by keeping it in the bank. Not even talking about how much it got taxed, because every return, right, that gets taxed as well. But we're not even talking about capital gains tax. Maybe you don't have to pay capital gains. We're not even going to talk about the tax. Just the fact that you parked that money in the bank on an average of 0.29% and the inflation rate was 2.3%, you lost money. Now, if we look at just investing in something simple like an index fund, which is based on the S&P 500, that same 20-year period. Now, remember, this includes the COVID crisis. It also includes the Great Recession, right, where we had big drops, right? This includes that. If we look at that same span of time, the S&P 500 in an index fund would have netted you 9.2% annual. So when you compare 9.2% versus 0.29%, and the inflation rate over that same period of time was over 2%, almost 3%, I think it's a no-brainer. You cannot rely any longer on a savings account at all. You cannot rely, not a traditional savings account. Now, are there high yield savings accounts? Yes. That are not based on a brick and mortar? Yes. The highest currently is paying close to 5%, maybe 4.89%, which will beat, right, the inflation rate, right? The 4.89% will beat the inflation rate. And should you have some money parked there? I think you should have some money parked there. But when you're talking about long-term, letting your money grow, I think an index fund or investing, right, in the stock market far outperforms a high yield savings account and definitely a traditional savings account. Not even close. Not even close. So is it sufficient to have a traditional savings account? If you want to lose money, then it's absolutely great for that. It is not good to preserve or to increase your money. Right? It's not good to preserve the value because the inflation rate cuts into that, and it's not good to increase the value. You have to have investing if that's your goal. You have to invest. And like I say, the simplest way is to get a S&P 500 based index fund. Just dump money in there. You know, should you have a high yield savings account? Yes, for certain things, right? For short-term savings goals. For an emergency fund, absolutely. I think you should have a high yield, again, right now, and that fluctuates, by the way, based on the interest rates. So right now, 4.89%, not terrible. But I think that kind of answers the question pretty decisively. Pretty decisively. It is not sufficient to use the strategies that your parents were successful with 30, 40 years ago. Not at all. I'd love to hear your thoughts on this. Please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.